Welcome to the Deep Dive. We're here to cut through the noise, give you the key insights.
That's right.
Today, we're getting into the weeds on DBS Group's recent second quarter 2025 earnings call. That's SGX D005. Our goal, get you up to speed fast on how one of Asia's biggest banks is handling, well, what their CEO called a perfect storm globally.
Yeah, quite the phrase.
It really is. And the market reacted strongly. Stock hit a record high after the results. Seems like a big vote of confidence.
Definitely. And we'll unpack how they pulled off these solid results with all those headwinds, lower rates, trade issues, currency swings.
We'll look at the financials, their strategy in wealth management, digital assets too.
And crucially, their guidance. It really stands out compared to some others who are pulling back a bit. It's a real study in resilience.
Okay, let's dive straight in then. The headline numbers, Q2 2025.
Right.
DBS reported a net profit of $2.82 billion. That actually beat the consensus estimates by about $50 million.
Pretty comfortably beat them, yeah.
And for the first half overall, total income climbed 5% year over year, hits $11.6 billion. Q2 also saw that 5% rise.
Solid growth.
Now, net interest income, NII, that was up 2% year over year to $3.65 billion.
Which is pretty remarkable given rate cuts are happening.
Exactly. Though net interest margin, NIM, did squeeze down a little. 2.05% from 2.14%.
A slight compression expected, maybe?
But the fee income side, that seems to be where the action really was.
Absolutely. That's where the diversification really, really shines. Commercial book non-interest income, up 11% year over year.
Strong.
And wealth management fees get this jumped up a huge 25%.
25%? Wow.
Yeah. And it's sticky. Assets under management, AUM, grew 16% year over year as $442 billion now.
Driven by that big inflow you mentioned.
Exactly. It's $9 billion in net new money this quarter. Normally they see maybe $5 or $6 billion, so quite a jump.
Okay.
And then there's markets trading income also way up. Rose by $231 million to $418 million.
So income streams firing on multiple cylinders. What about costs?
Yeah. Expenses rose about 5%, up to $2.27 billion. Seems pretty well managed against the income growth.
Right. Kind of in line.
And maybe the most interesting bit, showing prudence. Total allowances for potential losses actually decreased 10% to $133 million.
Lower provisions. That signals confidence in the loan book.
It does. So for the first half overall, profit before tax up 3% as $6.83 billion. Net profit grew 1% to $5.72 billion. These are good numbers, especially given that perfect storm backdrop.
That really puts the resilience narrative into focus. But, that perfect storm, lower rates, trade worries, currency volatility. How exactly did they navigate that? You mentioned diversified income, but what else?
Well, yeah, the CEO wasn't kidding. It was a mix of challenges, but they managed it partly through that proactive balance sheet management we touched on.
Right, the NII is still growing despite the NIM compression.
Exactly. It shows they're actively working their funding costs and asset yields, not just, riding the wave. And the big thing is they reaffirmed their full year outlook.
They did.
Yeah. Guiding for NII slightly above 2024 and net profit just slightly below. That's quite confident when others are cutting forecasts. It suggests they really believe their strategy works against these pressures.
Okay, let's dig into that resilience more. That 2% II increase with falling NIM, it really does suggest some smart moves. How did they actually stabilize that?
It really raises a point about strategic nimbleness.
Yeah.
A big part is strong deposit gathering. Got to have the raw materials, right?
The funding base.
Exactly. And then incredibly proactive hedging on the balance sheet. They hedge both U.S. dollar and Singapore dollar exposures.
So they're actively managing rate risk.
Very actively. Those U.S. dollar hedges, for example, average about 3 years in duration, and they're constantly replenishing them. It's not a set and forget thing.
Right.
The Treasury team is agile. They take a view on rates. They flex between fixed or floating strategies. The focus isn't just maximizing IM, it's growing the overall NII pot.
Interesting distinction. Prioritizing the total income dollars.
Right. And they're putting surplus deposits into high-quality liquid assets, HQLA, think very safe government bonds, things like that.
Okay.
Now, this boosts their return on equity, makes capital work harder. But crucially, it doesn't absorb much risk-weighted assets, RWA.
So it's capital-efficient growth.
Exactly. Growing earnings without tying up tons of capital against risk. That's key to how they can afford those higher dividends they're signaling.
Let's talk about wealth management again. That next $9 billion net new money inflow, that's huge compared to their usual run rate.
Right.
What drove that specifically this quarter? Was it just Singapore being a safe haven?
That's likely part of it, the safe haven flow. But DBS has this comprehensive approach. They call it the wealth continuum, meaning they serve everyone from the ultra-rich right down to, mass affluent retail clients, the very broad net. Combine that with just the general growth in wealth across Asia. But this quarter's jump probably also reflects their focus on more than just investments. They push estate planning, trust structures, insurance. That builds really sticky relationships, generates recurring fees. It's about holistic, multi-generational wealth advice.
Got it. And how does the digital assets piece fit into this? You mentioned income there tripled.
Yeah, tripled from 2024's $13 million, so a significant leap. They're aiming to be like the full infrastructure provider here. An exchange, yes, but also covering origination, issuance, trading, custody, settlement, the whole chain.
Building the whole digital highway.
Pretty much. But critically, it's focused on the B2B institutional space. Yeah. That lines up nicely with what Singapore's regulators, the MAS, are comfortable with business to business over retail crypto.
Safer, less volatile.
Generally, yes.
Okay.
Now, they do see a use case for stablecoins sometimes, maybe in less stable economies where a digital dollar is useful.
Okay.
But they're quick to point out their existing payment systems, Fast in Singapore, FPS in Hong Kong, their own GlobeSend, are already super efficient for most cross-border payments their clients need.
So digital assets are strategic, institutional, but not replacing existing efficient rails for day-to-day stuff.
That seems to be the message.
Okay, shifting gears slightly. Capital returns. They sound committed buybacks over 3 years, potential dividend hikes. How sustainable is that, especially if RWA, those risk-weighted assets, start growing?
Management sounds very confident. They're talking about another 6 cents dividend increase in Q4 this year and probably again in Q4 2026.
Really? Even if earnings are flat?
They've run simulations suggesting they can, yes. Their core capital ratio, that CET1 number, is 14.3%. That's well above their target range of 12.5% to 13.5%.
Solid buffer.
A very solid buffer. And it ties back to what we said about HQLA. Deploying deposits there boosts returns without eating up much RWA.
So they can grow earnings and returns without stressing their capital base.
Precisely. That's what underpins the confidence in returning more capital to shareholders through dividends and buybacks.
Makes sense. Okay, what about the core lending business? Loan growth, asset quality. Any concerns there given all the global uncertainty?
They're guiding for slow and steady non-trade loan growth, mostly from the institutional banking side.
Yeah.
Growth is a bit muted in Hong Kong and China, which isn't surprising. But Singapore looks strong. Large corporates, government land sales, infrastructure projects.
Like tech and renewables.
Exactly. TMT, renewables, often complex project finance deals, high-value stuff.
And asset quality. Are they seeing any stress?
They say they're being very conservative, especially watching China and Hong Kong real estate and consumer unsecured lending. Their approach is focused on predictive cash flow. Can the borrower actually generate the cash to repay?
Not just looking at collateral value.
Right. And they constantly stress test the portfolio. Plus, they have a big general provision reserve as $2.6 billion as an extra cushion, just in case.
An overlay buffer.
Yeah. Take their Hong Kong commercial real estate book, for example. It's $17 billion, but mostly concentrated in top-tier blue-chip names, and the loan-to-value ratios are conservative, typically below 60%. So very disciplined.
Okay, sounds like they're managing the risks carefully. So pulling it all together, what's the big picture takeaway for an investor looking at DBS?
I think it paints DBS as a real standout performer in a tough environment, facing tariffs, rate swings, global tax changes.
All that macro noise.
Exactly. But their diversified income streams, especially that booming wealth management business and the agile trading desk, provide a really strong buffer.
De-risking the earnings.
Right. And the fact that the management maintain their guidance when others are cutting back, that signals real confidence in their execution. They're positioning themselves as this digitally savvy, wealth-oriented, institutionally diversified bank.
A clear identity.
And you have this backdrop of geopolitical fragmentation actually driving capital flows towards centers like Singapore and Hong Kong. DBS is perfectly placed to catch those flows, to capitalize on that structural growth and wealth across Asia. They're almost turning global uncertainty into an advantage.
That's a fascinating angle. Turning uncertainty into an advantage, which leads us to think about maybe unconventional ways to view this. So let's do our not financial advice segment, just a thought experiment. If we were pitching an outrageous, but maybe plausible, trade idea based on DBS, particularly that digital asset capability they're building.
Yeah.
What could that look like?
Okay, yeah, purely hypothetical. We could call it something like a DBS Digital Wealth Infrastructure Note.
Okay, intriguing.
The idea is to give sophisticated investors exposure to the growth of DBS's institutional digital asset business, the custody, the trading, the issuance revenues.
But not the actual crypto prices themselves.
Exactly. You avoid that direct crypto volatility. The payout would be linked to how much profit DBS makes from these institutional digital asset services, maybe even leveraged if they hit certain revenue targets.
And the hedge. What makes it safer?
Two parts. First, you're betting on DBS, a highly regulated bank with MAS oversight focusing on institutions. That's inherently less risky than, say, the retail crypto casino.
Okay, regulatory clarity helps.
Definitely. Second, you could build in principal protection. Maybe fund it with a tiny slice of DBS's huge fee income pool. So even if the digital asset growth disappoints, your initial capital is safe.
So exposure to institutional digital asset growth via a trusted bank with downside protection.
That's the concept. It lets investors play the picks and shovels of the institutional crypto build-out through a major regulated player, capturing DBS's head start and holistic approach in this niche, while mitigating a lot of the direct market risk.
Interesting idea, playing the infrastructure through the bank. Okay, let's recap the actual results then.
Right.
DBS Group delivered a really strong Q2, showed impressive resilience in a tough global climate. Key points: strong growth, especially wealth and trading, costs under control, and that reaffirmed outlook stands out.
Management really emphasized the diversified income and the proactive hedging as key strengths, positioning DBS as stable even when markets are choppy.
Definitely stable.
And maybe a final thought to leave you with. As the world economy continues to shift and financial centers may be realigned due to geopolitics, how could that ongoing fragmentation further benefit banks like DBS? And what totally unexpected opportunities might pop up from these changing capital flows, maybe even beyond traditional or digital wealth? Something to think about.
A great question to ponder. Thanks for joining us for this deep dive.